Yesterday, the Fed raised their rates by 0.5 point and detailed plans for shrinking its nearly $9 trillion balance sheet to help cool U.S. inflation that's running at 40-year highs. But tricky questions emerge about what happens to the money in the system. Where does it go? Does it just disappear? Is it taken out of the money supply? Does it go somewhere else? Here's what happens when the Fed stops printing money out of thin air. All right, $9 trillion. That's a shit ton of money. So let's talk a little bit about where that money comes from. So to help stabilize markets during the onset of the pandemic back in 2020, the Fed started buying Treasury and agency mortgage-backed securities to the tune of $120 billion a month. And they bought these from primary dealers like B of A, Citigroup, JP Morgan, and a handful of other banks that are authorized to deal directly with our central bank. As the central bank's holdings increased, it infused financial markets with the liquidity and confidence it needed to keep credit flowing. This all helped usher in a speedy economic recovery from those early pandemic shocks. So simply put, the Fed buys securities, adds money to dealer accounts, all with the aim of increasing cash flow in the economy. This can't last forever, though, and Fed Chairman Jerome Powell now has a very difficult task of tightening financial conditions to help tackle inflation that was pegged at 8.5% in March. Way above its 2% annual target, all the while high fuel, food, and housing costs are threatening another downturn. So back in March, they started raising rates, continued to do so yesterday, and probably will over the remainder of the year. Also, starting in June, they're going to begin shrinking their $9 trillion asset portfolio, and this marks the most aggressive Fed tightening of monetary policy in decades. So where does the money go and what does it mean for us? Well, the Fed remits profits accumulated on its holdings to the Treasury Department every year, and in 2020, it was nearly $90 billion, which went to help foot the government's bills. So as the Fed looks to reduce the amount of money in the economy, there are a couple strategies they can use, and one of them is simply just letting the maturing bonds pay off. About $1 trillion worth of Fed-held bonds mature this year, with roughly the same amount next year, and $2 trillion takes a sizable chunk out of its balance sheet. But if the Fed is no longer serving as a key buyer of its debt, others need to step up. The Fed can also reinvest some of the proceeds from maturing bonds to buy more, thereby regulating the pace of its balance sheet runoff, much like it did after the 2008 financial crisis. But unlike earlier in the pandemic, the Fed would now be buying these bonds directly from the Treasury, bypassing the primary dealers and that cash infusion that saved us 2 years ago. So a third and perhaps more disruptive way would be for the Fed to sell its bonds on its book directly into the marketplace, which the March meeting minutes show that has been a consideration for its mortgage-backed securities holdings. So where does this put us all in 6 months to a year from now? Nobody knows, not even Powell, who estimates that we'll have a good chance at a softish landing. Yikes.